Welcome everyone to a webinar, Mastering USDT Payments, Compliance Regulations, and Invoicing for Electronics Wholesalers. Today we have a pretty packed presentation where we'll be covering a lot of key points and recent updates in the political sphere, as well as regulations, legal, and accounting practices as well for the electronics industry, which is right now where we're really doubling down with our payment system. So a little bit about me. My name is Luis Carchi. I'm the CTO of Shield Security. So right now, I'm in charge of leading the engineering team, but I also do a lot in sales as one of the co-founders. We really like to be next to the clients and hear directly from them and help them through all the needs that they may be having at any point. So a little bit about myself. I used to work at Meta and Instagram. So I spent about 3 years there before hopping over to what is now ShieldPay. So during my time there, I focused on the privacy and security features, also a bit about the Messenger and Instagram messaging system used to be separate, and we joined those backends. I'm not sure if you guys are Instagram users, but now you can see stories across multiple platforms, not just on Instagram, but you can see the Facebook stories as well, or see who's watching your stories from Facebook. So I was part of that team and transition. Before that, I was at Princeton University where I met one of my co-founders. We were roommates. So CEO Emmanuel Udatang, who's on the call as well. He and I met before we went to Princeton and ended up joining forces there. So we've been best friends before anything else, before we decided to found ShieldPay. So there's a lot of story here behind the company. That's a little bit about me. Going to ShieldPay, we raised $2.1 million in a pre-seed round. You can see a few of our investors here. We have A16Z, Crypto Startup School, Kraken Ventures, MoonPay, Turner Capital, to name a few. Orange DAO is one of Y Combinator's investment arms that invests in the crypto side of their portfolio. So we're backed by some pretty big names. Kraken is one of the largest exchanges in the US. They're a really good partner for us. And this was what kicked off a bit of the business, and we went through a lot of development, compliance work to get to where we are now. And we're early in the industry, but we expect to continue growing and continue helping all sorts of businesses to compliantly work with stablecoins and other types of crypto payments. So today we'll be joined by a few experts here. We have Ari Good from Good Attorneys at Law. He's a JD, and he'll be covering a bit about the legal. He'll give a legal overview of the crypto industry generally and the laws, some few case studies that we've seen, and how we can expect, us to be behaving regarding those legal procedures. We have Jaroslav Novaki. He is a general partner at Tau Legal. He works with us on the compliance side for the EU, and he'll be doubling down there on EU regulations and how that's a little bit different right now from the US. Tim Emratov, he is our compliance officer at ShieldPay. He'll be going a little bit deeper into the US cases here. And then we have Lorenzo Abatelio. He's a CPA based out of Florida, so he'll be covering really the invoicing and the tax consequences of working with stablecoins and other cryptocurrencies. So Lorenzo, actually, let me bring you up here. I just saw you. Let me know if you're all good there.
Yeah, I'm here.
Awesome. So just real quick, Lorenzo, we're having a little bit of trouble with the video, so we're going to be passing around the co-host function. Host just so we can get video on. But yeah, here are the experts in the industry we have, and I don't want to hold up any longer. I want to start off by probably, one of the biggest elephants in the room, the elections. I think we're still tallying votes, but it's pretty clear that Donald Trump has taken the presidency, and he will be in office starting January 2025. So as you guys can see here, this is a picture from the Bitcoin 2024 conference in Nashville that occurred a few months ago. So I was actually there. I was present during this conference. It was pretty terrific to hear firsthand what Donald Trump was saying, and I think what we can expect in terms of what is to come is a more open and supportive view of the crypto industry. So one key thing Donald Trump said is that the U.S. should be the number one nation for cryptocurrencies, and there's no reason why the U.S. should be lagging behind other regions such as the European Union, who have passed regulations. They've been very clear on what is expected behavior and what is not. So haven't been as transparent to us, okay, and what is not. They've been retroactively punishing businesses. The biggest businesses in the U.S., Coinbase, Uniswap, etc., have been served notices by the SEC. In some cases, there have been certain fines that have been given out. Coinbase has faced one of the biggest fines. And generally, the atmosphere in the U.S. has been unfriendly. So now we can expect a departure from those more strict policies, lack of transparency, and hopefully get some more friendly regulations passed. We have to see, what actual bills are introduced and what makes it to legislation. But the pricing in the market right now is showing a lot of optimism. Prices might change in the short term, but I think everyone is excited to get a new perspective on the legislator side, a new set of norms that companies can adhere to. So I think generally the momentum is going to stay, and I think the outlook is positive. We have yet to really see any impacts because of the presidential elections. We'll have to wait a few months to really see that go into action. We'll have to see, if the House and the Senate are Republican, so that will make it easier to pass legislation as well. But generally, very optimistic here, and hopefully we'll see some good legislation that allows the industry to continue growing and make certain processes like banking much easier. So that's on the U.S. election. We'll now go into a quick crypto 101. So in the electronics industry, I know that there's not a lot of what we call crypto natives. So what may be standard for some people that have been working in crypto for a long time, maybe a little bit foreign for users who are just now starting to work with stable coins or may have a bit of an interest in crypto generally. So I have real quick three topics I wanted to cover between, cryptocurrencies and the banking system. One key point is decentralization. And what we have to keep in mind here is that not every network, not every coin to say is the same in terms of its decentralization. There are certain networks that are more decentralized than others. For example, Bitcoin is generally seen as the model child of what decentralization is. The decentralization is really supported by the network of mining operations around the world that validate transactions and are able to keep that ledger up to date. And one thing to think about here is to shut down Bitcoin, you really have to shut down every single mine. It's going to be very hard to get cooperation across the board on all the miners to act in a negative manner. At least that's what the assumption is, that there isn't going to be any collusion to make any attacks. Like the 51% attack, for example, is if anyone controls 51% of the network, they'll be able to make certain decisions that don't depend on the rest of the network. No, so the assumption is that the decentralization provided by the mining operations is strong enough to hold any type of insider attack or any foreign attack that may want to infiltrate the network and use it for nefarious purposes. Other chains, such as I won't go too deep into other chains as well, but for example, Solana, BNB are more privately owned, we can say. There's more corporate influence behind those chains to various degrees as well. BNB, I'd say, is probably the most clear. It's part of Binance and their different networks that they operate. So there's a large influence from the corporation there. They can make certain decisions that single-handedly are up to them. There is also some trade-offs in control, as well as security is another part. One thing, for example, that you get as there's more control, you're able to get certain access to, password resets. I'll talk a little bit about why that's important on the wallet security. But it's not necessarily a bad thing to have more centralization, but generally the assumption is that crypto is decentralized. There's not going to be any interference from outside parties, such as the government, corporations, or any bad actor, right? So decentralization really means that you don't need anyone in the middle to move any type of money. You don't need a bank, you don't need a government, you don't need permission to onboard to the blockchain. Anyone can create a wallet. Now, when you start interacting with bank accounts to buy or sell crypto, that's where things can get a little bit more complicated. But in the sense of just having crypto, sending crypto, receiving crypto, there's no one really stopping you from doing that. And no one can access your Bitcoin wallet without the password or the keys. So it really is your money. It's not like, it can get seized by a third party unless they have the password. So there's more control, there's more custody in the favor of the user. So that is one of the big points here. And that is why a lot of people have flocked to cryptocurrencies from uh, places that may be going through economic turmoil, political turmoil. A case is Argentina, where inflation has been rampant. There's a control on how many dollars you can buy. They force you to hold the peso, which has been inflating year over year for many years. With crypto, there's no barrier to buy stable coins and make a hedge against inflation there. So a bit about the difference between Bitcoin and stable coins. Bitcoin varies in price. We saw a large increase last night due to the presidential election. Some positive momentum there. We don't know what's going to happen in an hour, tomorrow, etc. It's not so good to make payments, large payments, because the simple fact that if you send, a certain amount today, in the next hour, in the next few minutes, and the next day could be a completely different price. So Bitcoin, although has been like the standard, generally recognized as the first cryptocurrency, it isn't that good for making payments. So the price changes, but also the speed of it is not as great as well. It could take a long time to validate a transaction on the Bitcoin network. There are other things like the Lightning Network, which operates on top of Bitcoin. That's a little bit faster, but just the Bitcoin network is pretty slow. So that's where stable coins like Tether have popped in. There's been, a large adoption of Tether across the world because it is stable as per its name. It doesn't change in price. It doesn't go up or down as dramatically as Bitcoin or other cryptocurrencies. And it's one-to-one with the dollar still being one of the most used currencies in the world. So it's very good to make transactions, cross-border payments, peer-to-peer payments, because it's stable in price and it's pegged to the dollar. So it's something, familiar to the global system. And it has taken off. Tether is rising more and more as a share of crypto payments compared to Bitcoin and ETH, which are two cryptocurrencies that have dominated the market. We're seeing stablecoins do more volume than Visa and MasterCard on a yearly basis. So this is something that's really picking up. It's really catching flame, and I don't think it's going to stop. A little bit on wallet and security. So as I mentioned, when you own your own wallet, you have control of it. And if you don't have access to the password or the keys, you won't be able to log in and no one will be able to send your money, or you won't be able to access your money. So this is good and bad. Good because, it has a single point of access from the user. It ensures that no one, can go into the backend systems and reset your password, or, try to take over your account without your notice. It can be bad because if you forget your keys or you forget your password, there's no reset button on the blockchain. You can't call customer service. You can't reset that password, and that is really what can cause some issues sometimes. Users have lost a lot of money. There's a famous story of someone that lost a bunch of Bitcoin. They threw their hardware wallet into the trash, and they've been looking at it ever since. One other thing that can be a bit tricky with managing keys is there's a lot of hacks due to the mismanagement of keys. So if you have your password, you create your wallet, you want to make sure to never digitalize that across any of your devices. You don't want to have it on a, you don't want to have it on a Mac, on iPhone. You don't want to have it on anything digital because you might be infected with malware. Maybe not today, maybe not tomorrow, but one day, and they could scan your files internally to find what looks like a password for a wallet. So you can lose your funds. A lot of companies around the world have lost billions of dollars in very advanced hacks from governments, individuals, companies, etc. So there's a big risk in mishandling your keys. So what you want to do, as I always recommend, is have them written down on pieces of paper, multiple pieces of paper, and acting as if they were a checkbook, keeping copies in your safe, multiple safes, and not really allowing that to go on any online place that can be easily traced. One other thing that you can have is a multi-sig wallet or multi-signature wallet, which can be controlled by the approval of three or more. Generally, is how it happens. Three or more people that sign something is when funds can be released. Instead of one person being the sole signer of a wallet can be controlled by three people, for example. And then you can also make rules so that like 2 out of the 3 people can sign and a transaction will be approved. But that's a little bit about Crypto 101. It's not as complicated as people make it seem. It's really easy to get started and get the ball rolling once you adapt to the different, customs. But you want to make sure you're operating safely. And more importantly, you want to make sure that you're acting compliantly. So here's where we're going to start into the more detailed part of the presentation, going into what we call compliance and regulation. So Jaroslav Novaki is going to be the first speaker here. Again, he's a general partner from Tao Legal, so he's been helping a lot with the compliance on the EU side for us. And he's going to be talking about compliance in the EU. I'm going to give you now the host so you can turn on your camera.
Okay. Okay, thank you, Luis. Okay, so I'm Jaroslav Nowacki. I've been in the financial industry for like 15 years, and since 2016, I'm helping fintechs and crypto businesses, especially. And yes, I would like to give you some short insights regarding how are things going in the European Union. So Europeans do it European way. So right now we are in the transitional period. We are switching from local regulations to EU-wide regulation, MiCA. And MiCA is become applicable starting from end of December. So it's going to be fully applicable. And we are in the transitional period because before MiCA, all the crypto rules were set by local governments, local jurisdictions. So we had a really huge fragmentation of rules, regulations, and this is going to end with MiCA. And starting from next year, we are entering into grandfathering periods. What it means is that European Union allows locally registered virtual asset service providers to continue their operations without MiCA authorization, but for a certain period of time. And this will differ between jurisdictions. And those grandfathering periods allow to continue to provide services by all those locally registered virtual asset service providers. And starting from 2025, this is going to end. So with the 2025, we are going to see a market which is reserved solely for, so to say, crypto asset service providers. This is the actual term that MiCA uses. And those crypto asset service providers would be authorized with local supervisory authorities, but on the basis of rules that are generally applicable around Europe. So MiCA is a regulation, and it will be applicable in all EU member states. So no local separate rules for crypto asset service providers. And those crypto asset service providers, once they are authorized under MiCA, they will benefit from something that is called passporting. Passporting is a term that is also used with payment institutions and also with investment firms in Europe. And what it basically means that obtaining the license under MiCA in one country will allow to provide services in all EU countries. So this is a huge change because currently with those local rules, it's really difficult to provide services on the cross-border basis. Usually, this requires obtaining local registrations. And this is going to change. So on the basis of passporting, crypto asset service providers will be able to inform the local supervisory authority that they will be providing services in other EU countries, and that's all. So we are in a transitional period. So there's a lot of things that are currently changing, and the market is trying to align the operations to this changing regulatory environment. And one other thing that is becoming really interesting are the exceptions that MiCA provides. Those exceptions relate both to the possibility of decentralized finance being outside of MiCA. So there are certain projects that if they are deemed to be decentralized, they will be able to provide their services to operate outside of MiCA. We are not sure where this is going to develop to. As with the decentralization, it's an ongoing problem of deciding what the actual decentralization is. But there is an exception in MiCA, and my opinion is that there will be projects that will try to benefit from this possibility. Other exceptions allow, for example, to use the services of crypto asset service provider from outside of Europe by EU citizens. What it means is that MiCA generally prohibits actively the active marketing and selling of the services to EU customers, but it also allows for the EU customers to use the services from third countries. So this is based on EU treaties, and this means that that starting from 2025, we'll be able to see some actors, some entities that will continue to provide services in Europe, but they will not be able to actively market them and sell them to EU customers. So it will have to be a decision of the EU customer to approach this kind of institution and then use the services of such an institution. And as regards the stable coins, this is a bit complicated issue, as generally MiCA requires stablecoin issuers to obtain the license. So it's after 2025, it's not going to be possible to offer stable coins in the EU market without being authorized. And the tricky part is that this will, in relation to certain stable coins, such as USDT or USDC, this requires electronic money license. So this is some additional EU rule for stable coins that are pegged to one official currency only. And we can see that the largest players are already trying to align their operations. Recently, Circle with the USDC, they secured the electronic money institution license. We are not sure how the Tether will approach this, but the good thing is that stablecoins will be still available in the EU. The only tricky part would be that their active offering to the public would be limited only to institutions that have secured the MiCA license. And as regards the AML and CFT rules, This is outside of MiCA, but this is still governed by EU-wide laws. This results from AML directives that are applicable in the European Union. They've been implemented in each and every country of the EU. The level of implementations might differ, but the general rules are the same. So the requirements relating to KYC and KYB are similar around Europe. The requirements relating to transaction monitoring, the requirements relating to sanctions screening are the same. And of course, with sanctions screenings, we have our own local approach resulting from Russia's invasion on Ukraine. So those sanctions are extended to Russia and Belarus. So they might be different than sanctions that are implemented by other regions. But generally, those requirements are the same, and if they are to change, they will change for the whole Europe. And one of those requirements are, of course, the transaction monitoring, which is applicable not only to crypto institutions, but to other institutions as well. The interesting part of the transaction monitoring in regards to crypto is that, of course, it differs. And it's generally based on the market approach, on market standards, and it's not governed by any particular regulation in the EU, but it rather results from the market standards, from the available technology, and it's going to stay with us. So overall, I would say that we are in a transitional period. And the market, as we know it right now in Europe, will look totally different in 2025. We can expect certain crypto asset service providers to discontinue their services, resulting from the compliance burden. But on the other side, there is such an opportunity with obtaining the MiCA license and with being able to provide all services, all crypto services. To all EU countries on the basis of the passporting. And also we have those exceptions, which we lawyers do love, which I believe will be also used to the benefit of the crypto market, I believe.
Thank you, Jaroslav. Great stuff. If you can pass now the host to Tim, that would be great. So Tim Ermatov is our compliance officer at ShieldPay, and Tim has been helping us with a lot of the U.S. processes, making sure that we are doing what regulations have laid out. So right now he's going to go into detail with compliance in the United States. Tim, let me know if you can turn on your camera.
Hi, everyone. My name is Tim Ermatov. I'm the compliance officer at Shield. I do have around 13 years of work experience in financial crimes compliance, and I'm most recently I've been working with the crypto companies and advising them up to build their compliance frameworks properly and efficiently. So with this, I'd like to start and talk more about compliance in the US. So in the United States, distinguishing between securities and virtual assets is a foundational step in determining the regulatory path in digital asset that must follow. This classification directly affects a business's compliance responsibilities, licensing requirements, and also regulatory oversight. So for any US-based companies involved with the digital assets like USDT, understanding whether an asset qualifies as a security or commodity is essential for navigating the complex regulatory landscape in the US. So let's distinguish what is securities and what is the virtual assets are. So securities, assets classified as securities, such as stocks, bonds, or certain investment contracts, are strictly regulated by ACC. So ACC imposes strict requirements, including mandatory registration, periodic disclosures, and compliance with investor protection rules. So these regulations are designed to provide transparency, protect investors, and uphold market integrity. When a digital asset resembles a traditional securities in its structure, it may fall under ACC jurisdiction, which adds significant compliance obligations, including registration and adherence with the SEC's reporting standards, as we saw most recently with the Ripple versus ACC, as there's an ongoing battle going between Ripple and this government body. Virtual assets. So virtual assets are commodities like Bitcoin and USDT, and are often decentralized and do not represent ownership in the company or creditor relationship, like, for example, in securities. These assets are generally regulated by Commodity Futures Trading Commission, which is FTCS, under the framework that applies to commodities. However, the classification is not always straightforward. Certain features or the way these assets are marketed may bring under ACC scrutiny if they exhibit investment-like characteristics. SFTC oversees these assets primarily for fraud prevention and market manipulation, but it does not impose the same level of disclosure and investor protection standards as the ACC. So importance of the proper classification for businesses dealing with the digital assets, correctly determining an asset classification affects more than just compliance costs. It shapes the entire operational strategy from licensing to daily compliance obligations. Proper classification helps ensure alignment with the regulatory requirements, avoiding costly fines, legal issues, or forced operational changes. Adding another layer of complexity, the FBI recently has issued a public service announcement warning businesses and individuals about the risks associated with unlicensed cryptocurrency exchanges. So unlicensed exchanges often lack rigorous regulatory oversight, making them more susceptible to being exploited for illicit activities such as money laundering, terrorist financing, and fraud. Using these platforms can expose businesses to legal risks, heightened regulatory scrutiny, and potential financial penalties, and also jail time. Engaging with unlicensed exchanges not only makes really dangerous to businesses, but also increases the risk of unknowingly facilitating illicit activities, such as terrorist financing, sanctions evading, which can end really bad with the regulatory bodies in the US. So businesses dealing with the digital assets are strictly encouraged to conduct thorough due diligence on exchanges and their partners with only those that they have necessary licenses and regulatory approvals. Next slide, please. So let's talk about licensing requirements in the US. For US-based businesses that handle digital assets, such as cryptocurrencies, obtaining the proper licenses is crucial and very critical of the regulatory compliance in the US. So each license has specific requirements and obligations, and failing to secure the correct ones can result in severe penalties such as jail time, fines, business restrictions, or even closure. So let's talk about differences between these designations. Money transmitter licenses. At the state level, and there are 50 states in the US, the MTL is required for businesses that engage in money transmission, which includes digital currency transactions. Each state has its own distinct licensing requirements, often requires businesses to register, demonstrate their financial stability, and comply with the reporting or operational standards. The requirements can be different and it can be significant, with some states requiring additional security measures such as bonding, which serves as a form of insurance to cover potential liabilities. So in this case, navigating this unique state regulations can be complex and difficult, and businesses may need to obtain multiple MTL licenses, money transmitter licenses, if they operate across state lines. Money serves business registration is at the federal level. Digital asset businesses involved with the money transmission must register as an MSB with FinCEN, which is Financial Crimes Enforcement.
Okay, good afternoon, everybody. Thank you so much for joining. My name is Ari Good. I'm the president of Good Attorneys at Law. I'm a lawyer with 26 years of experience, primarily in transactional matters, so tax, securities, contract, international law, and so forth. And some 5 years ago, I decided to dedicate my professional energies towards the crypto sphere. So that's something that that I enjoy very much. And with that, we can get into talking a little bit about the law behind crypto and stablecoins in general. So, as a general overview, it's important to understand that the use of cryptocurrency as a means of payment or as a store of value in most of the world is not illegal. So you're not doing anything wrong by using cryptocurrency. Not only El Salvador, as the current day, has considered crypto to be legal tender, that is on par with its national currency. I think to their credit, I think they've got a very bright future the way they've embraced Bitcoin. So the bottom line is few countries require a merchant, for example, to accept cryptocurrency as a means of payment, but at the same time, few countries prohibit it from being used as a means of payment. So think of it like property. Whereas you're used to doing business in the fiat currency of your country, if somebody wanted to pay you in oranges or goats or tin or whatever else, crypto is largely considered property for most purposes under United States tax law, for example. And so when you're receiving this crypto in exchange, when you're out there doing transactions, selling electronics, what have you, think about it for the time being as receiving property in exchange for your goods or services. There's two main ways to look at crypto. That is, what is it? And Tim touched upon this a little bit. Is it a commodity? Is it a security? Or is it something completely new? And is it different from traditional payment methods? Stable coins have taken charge in terms of their usefulness as a payment method. I see a lot of transactions being settled in Tether and USDC, and these are, of course, examples of stable coins. There are three families of stable coins, or three different types. The first is a fiat-based or fiat-backed stable coin. So in the examples I just gave of Circle or Tether, these are somewhat centralized coins, but they are backed one-to-one, at least in theory, by the assets that they claim to represent. So in the case of Circle, they actually publish their proof that they hold the number of dollars that are in circulation in the form of USDC. Tether has been criticized for being not quite as transparent, but is a market leader in the use of as stable coins go, and Tether is a very important cornerstone of the crypto industry and how it functions. There's also such a thing as crypto-backed stablecoins. So stablecoins can be backed by anything to represent their value. In the case of something like DAI, it's backed by other crypto, in this case, Ether. And then for a time, there were the market experimented with what were called algorithmic stablecoins. These basically relied upon arbitrage to maintain a stable peg of the stablecoin to a dollar. Now, this is an idea that has largely been discredited, at least for a while, as we saw with the blow up of Terra Luna, that showed some of the weaknesses in that approach. But for our purposes, let's think in terms of stablecoins that are backed by US dollars or US government debt. Some of recent events have sort of they're sort of fading into the background now, especially that the election is over. But recent events colored how people thought about crypto and how governments approached crypto for some time. Binance and CZ were convicted of a number of serious offenses under anti-money laundering and counterterrorism financing laws, also that Tim touched on. Interestingly, CZ was one of the very few people to go to jail for offenses. Usually you see large fines in this area, fines against the banks that have engaged in violations of these laws, but it's very rare to see somebody to go to jail. I actually saw an interview with CZ recently, and he was surprisingly humble and not at all bitter about his experience, having been in jail for this offense. And he's got a great attitude looking forward into other entrepreneurial ventures. He's barred from being the CEO of Binance, of course, but that's not to say we won't see more of him. In Binance, what was interesting, and that's important to remember, is that no client funds were lost, nor did the United States government allege that they were. Binance was also an interesting case from the standpoint of U.S. jurisdiction. This was a foreign company, and the source of U.S. jurisdiction at the end of the day was because they had U.S. customers. So that's something to keep in mind for those of you who run businesses internationally, is that having U.S. customers can expose you to U.S. jurisdiction of the courts and regulatory authorities. FTX and Sam Bankman-Fried was a different story. That was a story of fraud and manipulation. It was a very serious blow to the crypto industry, as he was convicted of commingling client and firm funds and losing those funds. Fortunately, I've had the opportunity to represent some people in the bankruptcy proceedings that have followed the FTX collapse, and they're going to be getting some money back. Not all of it, not at current day's prices, but I think the United States Bankruptcy Court, as well as the Bahamian Bankruptcy Court equivalent, have actually done a fairly nice job of doing what they can to recover the lost assets in that case. Next slide, please. So there have been positive developments. Even before the election, there was the emergence and the approval of the BTF and ETFs, which has attracted a lot of institutional interest and a lot of institutional money, as well as retail interest in retail money. It has given people an opportunity to buy into crypto without having to understand the nuances of a wallet and how you hold it and how you secure it, which is still, in my opinion, something that the crypto industry needs to improve, is the usability of crypto natively. With that, let's take a look at some emerging legislation and trends that have been in the works that pertain to crypto and that pertain to stablecoins. Today, stablecoins are privately issued. As I mentioned, the sources of stablecoins have been the likes of Tether or Circle, both of which are private companies, which is very interesting because back in the dawn of the United States, there was no Federal Reserve. There was no single currency. States and even banks issued their own notes against deposits that they held. And in a way, we've almost come full circle in an electronic way, whereas stablecoins are privately issued. So the government is taking a look at stablecoins and they're thinking, how do I regulate this? How do I prevent fraud, protect consumers, and serve very important interests in the stablecoin markets? A number of legislative proposals have been put forward to sort of address some of those concerns. Senators Lummis and Gillibrand, in particular, have been very active in proposing bipartisan legislation that is designed to promote stablecoins and promote the advances of the crypto industry while protecting consumers and serving these other interests. The Lummis-Gillibrand Payment Stablecoin Act is currently pending. This classifies stablecoin issuers as financial institutions, which subjects them to all the anti-money laundering and counterterrorism financing provisions of the Bank Secrecy Act. It addresses custody and the safekeeping of stablecoins and other digital assets. So, and it's very important that the public is able to trust stablecoin issuers. Very important to understand that their stablecoin is actually backed by the funds that it's supposed to be backed by. And Lomas Gillibrand have also sponsored the Responsible Financial Innovation Act, which speaks to stablecoins, but it also speaks a little bit towards the competing jurisdictions of the SEC and the CFTC. Something that is also an underlying theme here is who's in charge, who actually gets to regulate these assets. Another piece of financial or legislation that's come forward is the Financial Innovation and Technology for the 21st Century Act, or known as FIT 21. Also has strong bipartisan support. It's currently pending in Senate committees. This seeks to carve out jurisdiction over digital assets by splitting authority between the SEC and the CFTC. So it creates, we talked about, what is a digital asset? Is it a security? Is it a commodity? This legislation proposes to give it a completely new existence, legal existence. And the SEC and the CFTC would still have regulatory oversight of it, but in a new way. The stablecoin provisions notably of the FIT 21 Act exclude the SEC from the stablecoin issuance and administration, which in my opinion is a good thing, because the SEC has traditionally been concerned with for-profit businesses, things that the classic Howey test that we hear of all the time basically is designed to address centralized profit-making industries. Well, a stable coin is designed to be stable, to maintain a single value. So by definition, it's almost not a security. Next slide, please. There is some other legislation that has been pending in the House and the Senate. Versions of the Clarity for Payment Stablecoins Act in the House, which again defines stablecoins, gives it a legal existence that it has not officially had before. It too removes stablecoins from the SEC's purview for the reasons that I described. The SEC should be concerned with profit-making centralized businesses. It allows for both federal and state agencies to regulate stablecoin issuers. Here again, we see the tug of war between who gets to regulate what. And because it allows for both federal and state oversight of stablecoins, it has faced some opposition due to this federalist approach. The Senate version consolidates federal oversight under the OCC for non-bank issuers and the Federal Reserve for banks. So here they want stablecoins to be under the purview of existing institutions other than the SEC and the CFTC. This version balances federal and state regulatory authority and requires stablecoin issuers with over 10 billion in assets, which is easily the big ones, to transition to federal oversight. When I wrote this a whole day ago, we could talk about the ever aggressive SEC. The SEC has been very aggressive and somewhat hostile towards crypto over the past several years. We talked, Louis mentioned the action against Coinbase, in which the commission alleged that various tokens in Coinbase's staking program are securities, and that Coinbase itself is an unregistered broker, exchange, and clearing agency for securities without having been registered. The Ripple case, which the SEC recently appealed, was a split decision, which considered the issue of, again, what is it? What is crypto? In that case, it was split in the sense that they found that stablecoin, that XRP sold to retail customers was not a security, but those sold to institutional buyers were. It'll be very interesting to see now that the administration has changed. I think we're going to see a much friendlier SEC. There's rumor that Hester Pierce, who's known as Crypto Mom, might be put up at the chairmanship position of that agency. We'll have to see, but I think overall we're going to see a much more friendly crypto environment going forward. And I think we can see the probability of some of this legislation that I mentioned being passed into law. Thank you very much.
Thank you, Ari. That was a great presentation. Now moving towards the for speaker, Ari, if you can give Lorenzo the host permission, that would be great. Lorenzo Abatelio, I hope I'm saying that correctly, is a CPA based out of Florida. He will be kicking off the next parts of the presentation.
Great. All right. Pleasure, everyone. And yeah, my name is Lorenzo Abatello. I'm CPA. Been in the crypto market, really around since 2016. Had some friends get in the industry, and they had a whole group together, and they came to me with a lot of different issues and solutions. They were trying to find, how can I even just get my books together? And that was where I started to tiptoe into the industry, worked with a whole group of guys. And since then, I'm still, friendly and clients with the majority of them. They've done really, really well over the years. And that just really pushed me to grow my practice, where we fast forward today, where we have really an umbrella of financial services, and not just, crypto related, but there definitely is a focus there, where we've moved people to Puerto Rico, and then there's estate planning, obviously legal and compliance. But, really from the core fundamental side as a CPA, look at it from a tax standpoint. So I'm really looking to help more of the users of crypto. Like today, Tim and Ari, they really spoke a lot about on the regulation side. Even Yaroslav spoke about a lot of the EU regulation. When it comes to businesses that are working in the crypto space, there's a lot of red tape. Especially in the US, things are not clear. We have a lot of clients that are maybe starting projects, and they want to do things the right way in US, but they have to kind of tiptoe around these guidelines. On the contrary, from an individual standpoint, from a business that's actually taking on payments or paying out expenses in crypto, that regulation honestly is pretty clear. I think it's going to become even clearer with obviously the new administration just being more crypto friendly, but I don't see it being a bad. It's not that there's not. That's not the biggest hurdle in the regulation. I think the biggest hurdle for individuals or businesses using crypto is the actual execution of, how do I get my books right? How am I recording this properly? If I'm ever audited, I don't even know what to do. What tools do I use? Those are really much more the concerns. So I know today we wanted to talk about invoicing in the crypto space. And while that's a very narrow topic, we can talk about, very broadly about many other things. But if we kind of just stay really focused on the topic at hand, it's invoicing in crypto. So when I'm thinking about that, I'm thinking I'm a business. I'm interacting with another company, whether I'm sending out crypto payments out or I'm receiving crypto in, whether that's in stablecoin or any other, just crypto in general. How am I recording that? And when I look at it from a business standpoint, it's not much different than operating on your everyday. You're sending out an invoice. An invoice is an invoice. It's not really much different if you're accepting it in crypto or fiat. Like, I'm going to send an invoice out, whether I do it through a CRM or I do it through a certain service. I'm going to do it probably in my normal course of business. Now, you can tailor it. It's not required, but you can tailor it more to the crypto space. And I think there's a lot of factors to determine what is that specific software. So like when I look at it, the size of the transactions obviously is gonna depend on what you're doing. The volume of the transactions is going to be dependent. The variety, if it's just stable coins or you're using a whole basket of different cryptos that you want to accept. And even the size of your business. I mean, if you're a publicly traded company, if you have audited financials, you have a whole set of different concerns to go by, versus if you're just, small business, even like myself as a CPA firm, if someone wants to pay me in crypto. So there's a lot of factors there to determine what is the best way to move forward. So if I had to give some solutions for people, I think the first most important thing is having the right books, understanding your numbers, understanding your data, because your data is going to drive decisions. So again, let's go back to those, like really, I think there's 4 or 5 sets I said, is like the size of the transactions, the volume, and the variety. So I think volume is the biggest I'd say factor here in determining what to use. So like there's retail services like a Coinly or a Coin Tracker, coin tracking, tax calculator. There's like so many different of these out there. They all have their flaws. I don't think there's one that's like the best per se. I think that they're really subjective on what your need is. So like for us and for our clients, like we use Coinly for a majority of the investors, even if they're businesses, because I get great pricing on it and it's very user friendly. However, if someone does 150,000 transactions, the software starts to break at a certain point. Like over 25, 30,000 transactions, I mean, the thing takes 2 hours, 3 hours to recalculate. So if someone's using bots or they're doing an immense amount of volume, that's not the solution. Now, let's talk about even like I said, even the size, or even just now the type of business that you are. Let's say because you're doing all that volume, you want to set certain rules and you want to connect it to your accounting software. So like, let's say a normal business uses QuickBooks or SAP or whatever you use to do your bookkeeping. Let's just use, say, QuickBooks, as it's the majority of the clients that we work with. Coinly doesn't interact with QuickBooks, so it's a very manual process. So if you're not doing a ton of volume in the industry, then doing it manually with a Coinly to save on budget is appropriate. Because some of these, like a Cryptio, for example, is more geared towards a publicly traded company that needs audited financials. You know, a lot of Big Four uses Cryptio. They work really closely with them. So with them, that's more geared towards the publicly traded company. So like, there's not a one size fits all solution. It really depends and is bespoke depending on your needs. And that's something that we work with clients on. It's just having that conversation, dissect what exactly does the person need. Now, I guess to continue where I think a lot of the other conversations were going is, what's the current regulation to be aware of and what is it like going forward? Currently, something just came out recently that I think could affect people on how they manage their books. And now a lot of these accounting softwares are providing this solution already internally. So it's not a huge concern per se, but it's wallet-based cost tracking of basis. Now with ShieldPay, they deal with stablecoins. So stablecoins don't really change. Like if someone pays in Bitcoin, it's converted automatically into a stablecoin and you get 100 grand that comes in as a payment. That basis is that basis. It's not going to fluctuate. But if I have let's say I receive the payment in Bitcoin at 75,000 where it's at today, and my basis is 75,000 when it comes into that wallet, and then I send that Bitcoin to a ledger, and then from that ledger I send it to an exchange to cash out or to an OTC desk to go to my bank. At that point, the basis needs to be tracked wallet to wallet. That's a new regulation that came out because a lot of these softwares were able to use different accounting methods within one wallet or across a whole span of just like consolidated transactions. So whether that's first in, first out, specific identification, last in, first out, highest in, first out, all these different methods of tracking basis can really sway the amount of capital gains or losses an individual or business has. And it can make a huge, huge difference. And especially when you're dealing with larger volumes, it can sway it by like a very, very large percentage. Because if someone's been in the market for a long time, they have bases all across the board. So if they have a really low basis on Bitcoin when they first started in the market and they just received, a payment in at the current market, let's say a 75,000, if they're doing highest in, first out, the highest in basis will be the first going out. So the government knows about this. They generally have their favorites on it. So that's what current regulation is really changing, is tracking this stuff at the right basis so there can be consistency across, because I'm just seeing it from our clients. We've been through about 15 audits at this point. It's a disaster. Some people's situations are just extremely complex, and it's very difficult to get an exact, precise number. There was one thing that I believe Tim mentioned earlier that is a great solution, but again, it goes back to now budget, which is one of the factors I mentioned earlier. How much are you willing to pay for compliance? If you're a $2 million business, spending $50,000 in crypto software probably isn't realistic. But if you're a company, $50,000 may be immaterial. So that on-chain analysis, or chain analysis of the specific company, is what the IRS uses in many cases on bigger jobs, because it will track the on-chain data. I've had a situation where a client of mine died and he took investor money, like 8 figures in investor money. the guy died, and we use chain analysis to put a few of the wallets in and just creates a spider web. And with that spider web, you can see how much funds goes to what location. You know, it shows like a indirect and direct exposure to risks or to compromised wallets. Maybe they're working with a foreign overseas company. You can see all that stuff with the on-chain data. So those are some of the tools that we use. Obviously, we stayed kind of narrowly focused more into businesses and invoicing and how that works and the solutions that we have, but happy to answer any questions later that are more geared to specific, situations with yourselves as clients.
Thank you, Lorenzo. We're going to move on now to a pretty interesting speaker here. So I'm going to be joined by Josh and Zoe. Josh has been with us since the early days. Josh is the CEO of Eze Wholesale, ezewholesale.com. Josh is involved in the electronics wholesale market. He has a marketplace where many sellers and buyers go online to find their goods, find the right prices. So I'm going to promote Josh here so he can share his video and give you guys a first-hand experience of being a Shield user, and he can talk a little bit about what that's been like.
Yep. So thanks for the introduction, Lewis. Happy to be here. One of the early users of Shield. It's been a tremendous resource for us, especially with offering alternative payment methods. So we run a marketplace for electronics, smartphones, tablets, wearables, gaming, drones, etc. One issue that we found was that users would come onto our platform from various places in the world, Latin America, the Middle East, from Europe, and they would have issues with transacting. So not being able to get USD to send us payments because we were only settling USD at the time. But then even for settling larger payment amounts in different currencies, like the Mexican pesos or AED in Dubai, it was difficult for us to transact like that. So a lot of clients asked us if they could send us USDT, and there wasn't a way for us to convert it in a way that was easy and was kind of cost effective for us. And Shield and us got into a conversation, and we decided to just partner with them. Ever since they've been transacting and handling all of our USDT payments, and we actually use them for payouts as well. So if a client or supplier wants to be paid in USDT, we will actually pay to Shield, and they'll do that transaction for us. So all in all, we've done over $750,000 with Shield since we've been with them, and we've integrated them on our platform as a payment provider. So users come on our platform, and as they're checking out, they can pay with USDT instead of paying by credit card or wire, which are some of the other options that we have. And yeah, I think that's just a bit about us, what we do. I think the beauty of using USDT, I would say the one other thing that I will mention is in our space, there's a lot of fraud. Lots of companies that will come and will deposit a fraudulent check and tell you to ship, or they pay by credit card and then do a chargeback later on. And so as someone who is handling a lot of money, but also wants to have peace of mind that payments will not be rejected or returned, Shield has been great. Transactions are confirmed and approved within seconds. And we know that those funds are legitimate. And with Shield's, compliance checks, we know that the funds are coming from a legitimate source as well. So really helps out with our KYC, but also, compliance risk as well, as, Ari and Lorenzo have spoken to earlier. So yeah, that's just a bit about us and what we do. And yeah, Shield has been a great for us to work with, kind of venturing into this crypto space. Yeah.
Talk about ShieldPay as well. So if you have a question, interrupt me. But ShieldPay, again, we're a venture-backed startup. We've been working in the industry for about 3 years, and we've been operating as a compliant entity in this space for about a year. We used to be in cybersecurity, but we made the pivot into payments. Over the last year, we've gotten our compliance set up. We've been working with some of the folks on this call, and we've been able to onboard a lot of folks in the electronics industry, helping them make payments across borders, receive payments across borders as well, helping them navigate the different regulations in their states and their countries that allow them to legally and safely operate with stablecoins and other cryptocurrencies. I'm the CTO. I manage mostly the engineering team, but I've been working a lot on sales. As a co-founder of a startup, you kind of wear a lot of hats early on. So been doing a lot of sales. I've been doing a lot of compliance work as well. So I've been around, a few sectors of the business. But it looks like we don't have any more questions. If you have any questions privately that you may want to reach out individually for a case-by-case basis with any of these experts on the call, I will be sharing that information as well, so you guys can reach out directly. Otherwise, for attending the call, I want to thank you for your time. I know it's been a lot that was said, so a bit hard to digest, but like I said, we'll be giving out a recording so that you can go back and watch it. Thank you very much for the production team as well. They've been doing a great job behind the scenes here. It's a lot of complicated stuff that's going on. Our first webinar, so we'll be improving all these processes in the future to make them better. But other than that, everyone, I hope you guys have a great rest of the day, a great week and weekend that's coming up.
Thank you.
Thank you.
Thank you very much.
Bye, everyone.